Namibians digging in their pockets as the annual average inflation increased.
The increase of this inflation is mainly on account of food and non-alcoholic.
I can't bathe anymore. This is rising, that is rising, everything is rising in terms of prices. The only thing that remains the same is our salaries and wages. We have less and less money to actually buy what we need to survive. Yo, I'm so annoyed. Everything is expensive. Anyway, as I was saying, did I say it yet? Oh no, I didn't say it yet. Welcome to our first lesson in our 5-part series by NAMCO for Economics Advanced Subsidiary Learners. In today's lesson, we will be talking about income and cross elasticity. But before we get into it, here is our learning objectives. At the end of this lesson, learners should be able to explain the term elasticity of demand, identify and describe the factors affecting elasticity of demand, discuss the implications of price, income elasticities of demand, and cross elasticities of demand on business revenue, and evaluate the implications of cross elasticity of demand on business decisions. It's a mouthful and probably an earful for you. So fasten your seatbelts, here we go. In grades 10 and 11, you learned about the effect that price has on demand and supply. Can you still remember that? The effect of price on demand and supply is known as price elasticity of demand. The word elasticity refers to the ability to stretch, to change. Elasticity of demand then refers to the fact that sometimes everybody wants to buy a certain thing. Let's say masks or sanitizers. And the prices of masks and sanitizers shoot up beyond their real value, right? And then one day, the health minister declares that masks are no longer necessary. And can you believe it? Nobody now wants to buy a mask anymore, and the price drops instantly. That explains price elasticity on demand. Elasticity of supply works in the same way when something is scarce, meaning supply is low. Then everybody understands that such an item will be expensive. It's a scarce item. For example, fuel in the current time of war. And equally, as long as there is an oversupply of something, like the years when plastic bags were freely available, we considered them worthless. It required the authorities setting a price on them to make plastic bags an item of cost, for us to start reusing them for our shopping and carrying goods. Price elasticity of demand measures the responsiveness of quantity demanded due to a change in price. Let's see just how the demand will change when there is a change in the price of a product or a service. The responsiveness of quantity demanded depends on a few factors. In grade 10, we looked at the following factors. Factors affecting price elasticity of demand are the availability of substitutes. If you actually wanted a wool blanket, but it's too expensive, you might decide to buy a cheaper polyester blanket instead. It's a good substitute. But if the wool blanket was the only warm blanket in the middle of winter, you would be willing to pay more for it, right? Another factor is if the product is a habit-forming or addictive substance. The demand will always be high, regardless how much the price goes. That's what we call a sad fact. The third factor is the proportion of income which is spent on a commodity. If an item swallows up half of my salary, I would try not to buy it very often, perhaps like a trip to the coast. This is similar to the last factor, whether the item is a necessity or or a luxury good. Viewers, since the beginning of the year 2022, we have seen a lot of price increases. We can hardly put up with unemployment and our small salaries. Now, what we want to look at now is how those price increases actually have an effect on demand. There has been electricity price increase and more are coming. Most households in Namibia use electricity for lights, cooking, and heating. And because we always need light and energy for cooking as well. This indicates that the price elasticity of demand for electricity will be inelastic, meaning if the price of electricity increases, most households are still forced to buy electricity. Secondly, due to the war between Russia and Ukraine, we have seen an increase in the prices of food and fuel prices. Also for these goods, price elasticity of demand is inelastic. Firstly, we need food to survive, so food is a need. People with cars need fuel for their cars to move from one place to another. And if you don't have a car, it is worse. You have to pay a taxi to get you where you need to be. Also this year, Namib Mills has announced price increases on basic food staples. This means wheat flour, bread, rice, pasta, maize meal, and instant porridge are all more expensive from late April. The supplier said the price increases were caused by rising transportation costs, meaning it was a knock-on effect from the increased fuel prices because the goods come from South Africa by truck. Other factors blamed for the price hikes were supply chain disruptions and raising commodity prices. Viewers, those are just some of the price increases we have experienced this year so far, and it seems like there is more to come. Sure. But anyway, as they say, the show must go on. Now, what we want to look at now is how changes in price has an effect on business revenue. When demand for a product is elastic, a fall in price will increase total revenue, while an increase in price will reduce total revenue. And on the other hand, when demand for a good is inelastic, a fall in price will reduce total business revenue, while an increase in price will increase total revenue as well. This means that for goods that have an inelastic PED, or price elasticity of demand, businesses will not make as much revenue when prices are low as when the prices are high, because consumers will not respond to change in price. This is common among goods that have no close substitutes. For example, food, because people need to survive, or goods with habit-forming elements such as alcohol and tobacco, which are addictive. Viewers, since COVID, many businesses have given up. Not only did they lose employees, the borders between South Africa and other countries have disrupted the supply of imports. But inside the country also, people's income shrank more and more. Business owners can tell you they struggle to pay their rent, and their customers, who's me and you, simply did not have money to buy as we could before. In economic terms, this influences the changes in the price of goods and services and how this impacts the total revenue of a business. Do you see the difference between these concepts? Earlier we spoke about the price elasticity of demand and how changes in the price of goods affected the total revenue for a business. Now, we want to look at the concept of income elasticity of demand and its effect on business revenues. Income elasticity of demand refers to how the demand for certain goods and services will change when there is a change in income. When the income of consumers increases, most people tend to buy higher value goods because they can finally afford them. They would, for example, forsake our delicious mahangu and buy more luxurious pasta, which they can now afford. and they will require fewer items of certain types as the income increases. Look closely at the definition of income elasticity of demand. Income elasticity of demand, YED, is defined as a numerical measure of responsiveness of quantity demanded due to a change in income. This simply means income elasticity of demand means people want to buy more of some things and less of others when their income becomes more or becomes less, so the demand for certain products changes accordingly. Let's look at how demand will change once there's been a change in income. When the income changes, an increase in income leads to an increase in the quantity demanded. A decline in income leads to a cut in the quantity demanded. Then there is a positive relationship. The product is classified as a normal good. Again, if an increase in income leads to an increase in quantity demanded, then there is a positive relationship, and the product is classified as a normal good. Normal here does not mean that other goods are crazy or abnormal, but it means normal goods are standard, regular, or typical. So, if quantity demanded is increasing due to an increase in income, businesses will receive more revenue if they produce normal goods. It seems safe for a business to produce or sell normal goods. However, there are some products referred to as inferior goods, which exhibit a negative relationship. Inferior means substandard or poor quality. So an increase in income would cause a reduction in the quantity demanded for inferior goods, which would, in return, reduce business profits. So businesses will start producing less of inferior goods as the demand for these goods is low. Simply stated, whereas you used to buy in Chinatown only because that's all you could afford, your income is now higher, so you shop at Woolworth, perhaps. Which means that Chinatown shops might feel the pinch accordingly, that is for normal or regular goods. Consequently, such businesses would stop producing the goods their consumers do not want, which would impact the income of the producer. Viewers, interesting stuff, right? I'll have to agree with you. I love schoolwork that actually applies to real life. Now, I told you that income elasticity of demand can be calculated. For businesses, this is good news because then they will know why customers actually stop coming to their businesses. Now, in order for us to calculate this, grab a pen so we show you how. To calculate income elasticity of demand, we divide the percentage change in quantity demanded by the percentage change in income. Again, to calculate income elasticity of demand, we divide the percentage change in quantity demanded by the percentage change in income. If the answer we get is bigger than 1, we produce a normal good. But if the answer we get using the formula of income elasticity of demand is less than 1, the demand for that good is inelastic, meaning that good is an inferior good. The product is inferior. Let's calculate an example. Say that recently the average income level has gone up by 25%, which has resulted in more people eating out. Consumers have been spending their extra money on food consumption by 25%. We can calculate the income elasticity of demand based on this given information. We have to divide the percentage change in quantity demanded, which is 75%, by the percentage change in income of 25%. So, we put the 75% over the 25% and get an answer of income elasticity of 3 for food. This is more than 1, so that food is clearly a normal good. It is quite safe for the business to keep producing food. They will still make their profit. Before we conclude today's lesson, we have to look at one more concept, and that is cross-elasticity of demand. Cross-elasticity of demand measures the responsiveness in quantity demanded of one good due to a change in price of another good. For example, a rise in the price of Pepsi causes a change in the quantity demanded of Coke. These two goods are related, so an increase in the price of one directly impacts on the price of the other. We calculate the impact of cross-elasticity of demand, meaning that one product's price makes on another, using this formula. Cross-elasticity of demand equals the percentage change in quantity demanded, or QD, of a good A divided by the percentage change in price of good B. The implications of cross-elasticity of change in demand on revenue and business decisions can be summarized into three factors. 1. The increase in price of good may cause a fall in revenue for the business because consumers automatically switch to the close substitute. 2. However, the price increase of one product may actually be able to attract customers away from rivals by lowering prices. 3. Revenue may increase if the product whose price is lowered is paired with an expensive complement. In this way, the business could force customers to buy the cheaper product and the more expensive one together. The business should then be sure that the expensive good is more attractive to consumers. Viewers, we've come to the end of our first lesson in our 5-part series for NAMCOL Economics Advanced Subsidiary level. Now, before we go, let's quickly have a recap on today's lesson. We spoke about elasticity of demand and said this refers to the responsiveness of quantity demanded by consumers due to a change in their income. The effect is calculated with this formula: percentage change in quantity demanded divided by percentage change in income. If demand is responsive, then it is classified as elastic and a normal good. If demand is non-responsive, then it's classified as inelastic or an inferior good. With an increase in income comes an increase in quantity of normal goods demanded. This is likely to increase total revenue for a business from normal goods. What's similar is a reduced demand for inferior goods spells reduced revenue for a business. Viewers, we hope to see you again. But until then, goodbye.